Friends, in this video, for ithought Advisor, I'm going to talk to you on the topic, what is creating returns for you? From 2018, I've seen one trend play again and again. That is, we believe that a particular investment style will do far better than the index. So, we believed in the buy at any price style of investing, where valuation didn't matter. You could just put your money in a particular style of growth oriented investing and everything will conspire to give you the returns. Now, this seemed to work during the first wave of COVID because money was coming into India at a very high velocity. It wanted to make money very quickly and get out, but we didn't realize that this money was short-term money. And that short-term money was going chasing whatever was the trend. So whoever managed to make their style into the trend got all the money. The same happened in the PMS space also, where investing in expensive growth-oriented stocks was what most prospects preferred when they looked at the PMS. So the AUMs kept rising where growth investing was happening at any valuation. But today, we are suddenly inverting the whole thing and seeing that the index has done better than this form of investing. Style failed, benchmark succeeded. Earlier, benchmark was struggling and style succeeded. So whenever we see success, we start chasing the success. But you have to be aware of the fact that in different market context, we will see different outcomes. We saw that over the last 4 years, small caps have continuously bounced back whenever they fell to claim a higher valuation each time they bounce back. PE ratios during every subsequent bounce back has been at a higher level than the previous rally. So now we are almost in a frame of mind where we think that low PE for small cap is impossible. So we think that small cap is very safe. And we also think that active investing, if done, must be only in the small cap space. Clearly, this is driven by very heavy recency bias. And the same recency bias is what caused the misallocation of large capital or huge capital towards growth stocks which were very, very expensive. When you chase recency bias, you stop controlling your portfolio, you stop controlling your own behavior with your portfolio, you stop controlling flows when it is not a good time to allocate, and you start thinking that the world will conspire to give you the returns. It never works that way. So today you have this peculiar situation where Nifty is beating BAAP investing and it's beating it very decisively. And you also have a peculiar situation where you are not sure whether small cap investing is going to fire continuously or it's going to take a pause. One thing that I have consistently learned is that whenever you overpay, you will have to wait for a long time. It's a very simple home truth for investing, because when you overpay, if your decision to overpay has to hold its ground, you need many times more people to come after you and overpay. And if economic circumstances don't allow that, you're not going to find that many people or as many people as you need. That in turn will lead to a cut in valuations. This is history and this will be the future as well. So be very clear on what you can pay, when you can pay, and for what you're paying. So what will create returns for you from here? I think what will create returns for you is fresh thinking, looking forward than looking in the rearview mirror, setting tighter valuation expectations, paying more judiciously for your fresh investments, investing continuously, and giving yourself more time. Only that will give you more returns from here. Blindly buying into any theme or anything that worked recently is not going to help you succeed. The markets are at a time when we are seeing massive rotation in trades. You will see further rotation when the new calendar year begins, and you will see that fresh money is going to the place where nobody is going to. You are seeing that even now, and you will see more of it in the next year. So, those who are sitting in the beaten parts of the market or in parts of the market where there is under ownership may actually end up making more returns than those who are sitting owning stocks which everybody has been talking positively about and which everyone is bullish on. That in essence is what you should remember when you make fresh investments in 2023, and that in turn will take you to a better place in the subsequent years. Thank you for watching this video.